In today's video you will learn everything about the double bottom chart pattern and how to trade the double bottom. Double bottoms can be very profitable reversal trades if you trade it the right way. However, many traders struggle to be profitable when trading the double bottom because they are trading every double bottom that they see. What many traders don't realize is that there are double bottoms that can be traded, while there are double bottoms that should be avoided. So how do you know exactly which double bottom to trade? In this video, I'll share with you exactly what a double bottom is and how to identify the 3 different types of double bottoms. Chart patterns form due to the interaction between the buyers and sellers, which generally leads to the various chart patterns that you can see on your chart every single day. Generally speaking, all chart patterns are looking at the interaction of supply and demand. In other words, this constant battle between buyers and sellers, so to speak, gives birth to the many chart patterns you're probably trading right now. What is double bottom? The double bottom breakout is a bullish reversal trading pattern that emerges at the end of a bearish trend. The reversal is composed of 2 consecutive bottoms with approximately the same equal lows. Although it is similar to the double top pattern, the only difference is it develops at the end of a bearish trend. The double bottom forex reversal, as the name suggests, is a trend reversal pattern. It is basically going to turn a downtrend into an uptrend. You can trade this chart pattern strategy on any time frame. However, the bigger the time frame, the bigger the potential profit. Moving forward, we're going to discuss what makes a good reversal. The first low is formed when the bearish trend finds support and the price retraces until it finds a resistance level that we call the neckline. In the second phase, the price moves downwards towards the support created early by the first peak. But it fails to break it, and instead rallies to the neckline again. Types of double bottom. There are 3 formations of a double bottom. While many people think that the double bottom is just simply 2 swing lows with the same low, there's actually a total of 3 formations of the double bottom that you need to take note of. 1. Double bottom with the same swing low. This is the most common type of double bottom that traders look for. 2. Double bottom with a lower low. The important thing to note here is that we don't want the second bottom to be much lower than the first bottom. If the second bottom is much lower than the first bottom, then it will be considered a normal downtrend wave, forming lower lows and lower highs. And that signifies a strong momentum in the downtrend. 3. Double bottom with a higher low. This can signify a weakening of the downtrend and could be the first higher low of an uptrend about to be formed. But not all double bottoms with higher lows lead to a reversal of the trend. That means you do not want to trade every single double bottom that comes your way, as mentioned before. You want to know how to identify which ones to trade and which ones to avoid, and only want to cherry-pick the ones with the highest probability of working out. Now that you know the 3 formations of the double bottom, let's get into the details of how to trade them. How to trade the double bottom. Trading strategy, break of neckline. This is how technical analysts trade the double bottom and is the most standard way of trading it. To place a buy order, you have to first identify the neckline of the double bottom. As you can see that the neckline is drawn across the peak between the 2 bottoms. Some traders go long at the break above the neckline, and some traders go long at the close above the neckline because they want to avoid false breakouts. So it depends on how conservative you are. If you are more aggressive, you can place buy order when the market breaks neckline, but if you're more conservative and you want to avoid false breakouts, you can wait for the retest or pullback above the neckline and then place a buy order. But take note, sometimes the price doesn't retest the neckline. So it's up to you. Risk it or you miss the chance. Here are the entry rules to place a buy order. Step number 1, identify the phase of the market. The double bottom reversal needs a downtrend. Just because you can spot the reversal, it doesn't mean you have to jump in willy-nilly. Remember, we need the right context and everything needs to line up for a tradable setup. So, the first step is to identify the phase or market condition. At any given moment the market can be trading either up or down, or it can go sideways. As we previously established, the trade setup needs a prior downtrend. Step number 2, the price creates the first bottom. Step number 3, the price action creates a top afterwards. Step number 4, the second bottom is created after the top. Step number 5, we plot the neckline on the top between the two bottoms of the pattern. Step number 6, the price action breaks the blue neckline of the pattern, creating a neckline breakout. Step number 7, buy when double bottom breakout candle closes above the neckline. After we identify the phase of the market and the characteristics of a good reversal, we need to wait for confirmation that momentum is shifting. The breakout candle is our signal that the momentum has shifted, and it's what it confirms and validates the double top pattern. The next logical thing we need to establish for the strategy is where to take profits. Step number 8, take profit at the same price distance as measured from the highest peak to the neckline. The minimum profit target for this type of trade is approximately equal to the same price distance as measured from the double bottom to the neckline. If we project the same price distance to the downside, we obtain our first take profit zone for the strategy. The double bottom pattern can produce a major reversal, so we advise you to be very flexible with your profit target not to miss any big profit opportunity. The next important thing we need to establish is where to place your protective stop loss. Step number 9, place the protective stop loss slightly below the support created by the double bottom reversal. The double bottom chart pattern strategy gives you a simple way to quantify risk because you can place your protective stop loss slightly below the double bottom pattern. The double bottom pattern really gives you the opportunity to also trade with a tight stop loss, which is great as we always want to keep losses at a minimum.
Thanks for watching. Hope you guys have enjoyed the video, and please don't forget to like and subscribe to the channel. I'll see you in the next video.